Hello everyone, and welcome back to Crypto in 5. With the new year kicking off, I want to start by wishing everyone a year of doubling your assets and progress towards achieving the dream of financial freedom. But hey, I know that over the new year, a lot of folks in the crypto space have been feeling a bit mixed. Look at where we are. Bitcoin is currently hovering around the $80,000 mark. I bet many of you are muttering to yourselves, ouch, what is going on? We hit an all-time high of $126,000 last October. So how did we end up on this roller coaster ride, correcting so much in just 2 months? The market is full of confusion right now. Some say the bull market is over. Others say it's just getting started. For the newbies who just entered last year, this feeling really sucks. You saw the institutions getting in, the ETFs getting approved, so why does that dream of getting rich overnight feel like it's fading away? Look, if you have these doubts, you've definitely come to the right video today. As our big opener for 2026, I'm not going to give you fluff. We're going to dismantle the underlying logic of the market and tell you exactly why 2026, the year we're in right now, is going to be the key year that Bitcoin breaks the traditional 4-year cycle curse. Wall Street is even betting that what's coming next will make last year's bull run look like child's play. Sound sensational? Don't worry. Today, I'm going to translate all those obscure macroeconomics and institutional games into plain English that everyone can understand. Are you ready? Buckle up. Let's go. First off, we need to grasp one core concept. What is the real driver of price movements in this market? There's only one answer: liquidity. Simply put, is there a lot of money in the market or not? So, what kind of environment are we in? We are in what the macro gurus have been calling the liquidity supercycle. Did you know, just last month, on the 10th of December 2025, the Fed made a huge decision. They cut the federal funds rate by 25 basis points, bringing it down to the 3.5% negative 3.75% range. What does this mean? It means the high interest rate era that caused us so much pain is officially over. It's been replaced by a new strategy of cutting rates to ensure growth. Here's the kicker. According to the Fed's latest dot plot, they're going to continue cutting rates throughout 2026, aiming to push rates down to 3.25% or even lower. Although there's still some internal disagreement at the Fed, the smart money on Wall Street has already started pricing in a soft landing scenario where inflation cools down gently and the economy keeps growing. This is absolutely massive news for Bitcoin. Why? Because Bitcoin is super sensitive to real interest rates. When bank interest rates drop but inflation sticks around, projected to stay at about 2.4%, keeping money in the bank stops being a good deal. Capital is then forced to flow out, hunting for inflation hedging assets like gold and Bitcoin or high growth assets like tech stocks. Think of it like a dam. The floodgates were closed, but now they've cracked open and water naturally flows to the lowest point. Models from giants like BlackRock and Fidelity show that if just 1% of the capital flows out of money market funds, it's enough to push the crypto market cap up by hundreds of billions of dollars. And it's not just the US printing money. We have to look at the crucial China factor. To fight deflation, China's central bank also started aggressive monetary expansion in the second half of last year. Global M2 money supply is approaching an all-time high of $130 trillion. Folks, remember this. Bitcoin's price trend has an 88% correlation with global M2. When central banks worldwide are turning on the liquidity taps at the same time, for an asset like Bitcoin with a fixed supply, it would be scientifically impossible for the price not to go up. This is a classic case of asset repricing driven by currency devaluation. Having covered the macro environment, let's see who is actually buying Bitcoin. People often called 2025 the year of institutions, but 2026 is the year institutions go from testing the waters to playing for keeps. First, there are the ETFs everyone knows. BlackRock's IBIT and Fidelity's FBTC aren't just trading tools anymore. They've become the market's anchor. I've noticed two very interesting phenomena driven by ETFs. Number one is passive buying. Pension funds and retirement accounts are buying regularly via dollar cost averaging, regardless of price action. This capital is incredibly sticky. Number two is floor price elevation. Whenever Bitcoin corrects by 15-20%, institutions have to buy in to maintain their asset allocation ratios. This means the brutal 80% bear market crashes of the past are unlikely to happen again in 2026. But here is the real bombshell. In 2026, bank financial advisors are entering the arena en masse. Before, compliance departments were blocking them, but now the green light is on. Tens of thousands of advisors from giants like Morgan Stanley and Merrill Lynch can finally actively recommend Bitcoin ETFs to clients this year. We are talking about hundreds of billions in new capital. This is the real power of retail investors. Beyond ETFs, there's another force we can't ignore: corporate treasuries. Everyone knows Michael Saylor from MicroStrategy is a madman, but in 2026, he's no longer alone. Just last year, public companies added over 130,000 Bitcoin to their balance sheets. Why? Because there's a secret weapon everyone ignored. Accounting rules have changed. The FASB's new rules allow companies to record Bitcoin at fair value. This means if Bitcoin goes up, it counts directly towards company profits. This is incredibly tempting for CFOs. It hedges inflation and beautifies the financial reports. Analysts predict corporate treasuries could hold $330 billion in Bitcoin by 2030. Even more wild is the sovereign game, basically FOMO at the national level. If the US actually starts building a strategic Bitcoin reserve, a super hot topic in Washington right now, other countries will definitely quietly follow suit so they don't get left behind. This is a total game changer. If this play actually pans out, the price chart is going to look absolutely legendary. Alright, so you might be asking, hey host, if so many people are buying, who is selling? The answer is, we are running out of coins to sell. Let's look at the on-chain data. Numbers don't lie. Bitcoin reserves on centralized exchanges have dropped to their lowest point since 2018. This is what we call a liquidity crunch. It's like walking into a supermarket and finding empty shelves. If a whale suddenly walks in wanting to buy $1 billion worth of Bitcoin, there simply isn't enough floating supply. What happens to the price? You get massive slippage, and the price just jumps straight up. Moreover, even when the price hit $126K in October, the long-term holders barely sold anything. What does that tell us? It means the consensus price is far higher than the 100,000s. Everyone is waiting for much higher prices. As for the miners, after the 2024 halving, inefficient miners were wiped out. The ones left are giants with excellent cost control. They aren't in a rush to dump Bitcoin to pay electricity bills anymore because revenue from on-chain transaction fees has gone up. So, to sum it up, demand is exploding, but supply is shrinking rapidly. It's basic supply and demand economics. How can the price not go up? This point is key, and it's something many crypto OGs tend to overlook. We used to call Bitcoin digital gold just a store of value, kind of useless, an inert asset. But in 2026, that narrative is being turned on its head. We are witnessing Bitcoin's productivity revolution. First, the explosion of layer 2 seconds. I have to mention Stacks here, which completed its Nakamoto upgrade late last year. How big is this? It cut Bitcoin transaction times from 10 minutes down to just seconds. The experience is now comparable to high-performance chains like Solana. Plus, they launched SBTC, allowing Bitcoin to safely enter DeFi to earn yield. Forecasts show Bitcoin L2 TVL total value locked, charging towards $50 billion in 2026. There's another massive innovation called Babylon. This protocol is expected to fully explode in Q1 of this year. It allows you to stake your Bitcoin to secure other blockchains and earn yield, but the key is you keep your coins in your own wallet, no bridging needed. What does this mean? It means Bitcoin now has a risk-free rate. If institutions realize they can hold Bitcoin and get 3 to 5% interest, their willingness to allocate will go up exponentially. Alright, I know what you care about most is the price. How high can Bitcoin actually go in 2026? I've compiled prediction models from all the major camps, so let's go through them one by one. Let's start with the mainstream Wall Street consensus, like Standard Chartered and Bernstein. Their target for year-end 2026 is $150,000. Their logic is based on ETF inflows and Bitcoin stealing market share from gold. From the current $80K plus price, that's about a 75% upside. To institutions, this is a conservative and reasonable target. Then look at the aggressive innovation models, represented by the famous Cathie Wood at ARK Invest. They believe if institutional allocation hits 1%, the price will easily break $200,000. Their S-curve adoption model suggests that to hit their multi-million-dollar target by 2030-2026 must see high-speed growth. Of course, we should also listen to the conservatives, or even the bears. Analysts at Fidelity suggested a mean reversion view. They think if the 2025 high of $126K was the top, then 2026 might be a digestion year, with prices chopping between $65,000 and $80,000. Personally, though, I lean towards the liquidity supercycle view. The traditional 4-year cycle might be invalid. We won't see those bottomless bear markets anymore, but rather a long, volatile bull trend upwards. By the way, besides these numbers, there's a wild card: AI. Institutions predict the convergence of AI and crypto will generate billions in revenue by 2030. Think about it. Future AI agents paying each other for compute or buying data, they aren't going to open bank accounts, right? They'll use the Bitcoin Lightning Network or on-chain stablecoins. This is another massive narrative for 2026. Having said all that, facing 2026, how should we retail investors actually play this? I have a few pieces of genuine advice, so take notes. Number 1, hold on to your core allocation. With macro liquidity overflowing and currency debasement, holding spot Bitcoin is the best tool against inflation. Don't let short-term volatility shake you out. Number 2, look for alpha in the ecosystem. If Bitcoin really goes to $150K, then tokens in the Stacks and Babylon ecosystems, being high beta assets, will likely outperform Bitcoin itself by a mile. This is the classic high risk, high reward. Number 3, and this is crucial, watch the risks. While we are bullish on the trend, keep an eye on US unemployment data. If unemployment spikes, say past 5%, the market might panic about a recession first, and Bitcoin could dump in the short term. Let's call it 2026 is destined to be extraordinary. We are in the final window of Bitcoin, transitioning from a speculative toy to a global core asset. Right now, what you need isn't panic, but patience. For patient capital, this might just be the best of times. All right, that wraps up today's Crypto in 5 2026 kickoff analysis. How do you see the market this year? Do you think Bitcoin can hit $150K? Leave a comment below and let's discuss. If you felt today's content helped clarify things for you, please don't forget to hit like, subscribe, and ring that notification bell. I'm CryptoVision. See you in the next video. Bye-bye.